The 2023 recession is about to get a lot worse, and it's primarily due to the fact that the economy looks really strong on paper, even though 87% of the people that answered this poll on my channel think that there's a likelihood that we head into a recession later in 2023. So why is the Fed continuing to push the idea that we have this super strong economy? Well, it's because we saw things like retail sales rebound in January. At the same time, we see the number of Americans file for unemployment benefits unexpectedly fall by another 1,000 to 194,000 claims. And that's offering evidence that the economy's resilience is there despite tighter monetary policy. And because of that, we've actually seen mortgage demand drop as mortgage rates inch closer to that 7% number in the midst of what we're calling a strong economy. And this is coming off the heels of disappointing inflation data. Even though we saw inflation moderate month over month, the numbers were still higher than the Fed was expecting. And because of that, we've seen the Fed's slogan say the Fed must be ready to hike rates for longer than now expected. At the same time, we're seeing other Fed officials float the idea of even higher rate hikes, while the Fed's muster says the Fed must be prepared to move higher and hold longer, while Bullard says further rate hikes can help lock in disinflation. At the same time, you have traders out there betting on this, saying that they see the Fed funds rate hitting 6% by September. In fact, there's an $18 million bet on this that pays $135 million. So traders out there are actually putting their money where their mouth is. So I want to talk about what's actually happened out there with Fed probability, with them raising interest rates after the latest CPI data, and what that actually means, what that means for us heading into recession, and how it's likely to impact you in 2023. But before we do that, I'd like to take a minute and ask a favor. If you find any value of the time I put into these videos, if you find any value in them at all, do me a favor and hit that thumbs up. It not only helps the YouTube algorithm push the video out to more people, but it also helps me accomplish my goal of educating buyers and sellers in this crazy market. So while the latest inflation data did come down, again, it was higher than many Fed officials out there, the economists out there, were actually expecting. And a lot of it had to do with the CPI report revealing that housing costs had increased substantially, actually to the highest level we've ever seen on record. And for anybody out there that's buying a house, that's renting a house, you know that housing costs are still a problem. But with that said, it's important to understand the relationship between housing costs and inflation data. So while we know rising home prices have direct effects on household wealth and neighborhood affordability, they also play an important role in overall inflation. The shelter component includes both rental cost and the consumption value of owner-occupied housing, as well as lodging, in addition to some other forms of lodging such as hotels. Shelter makes up nearly a third of the basket for CPI inflation and 40% of the basket for core CPI that excludes the volatile food and energy components. So because of the rising cost of rents and housing, we've seen inflation data continue to rise. But here's the thing, inflation data is actually lagging, especially when it comes to the shelter component. The latest data out there actually shows that rents are easing in most markets. And because the shelter component is actually lagging, we haven't seen that reflected yet in the headline and the core CPI numbers, which is a big problem because it shows that inflation is still up. And because of that, renters are finding it easier and easier out there to find rental properties. And that will likely continue into 2023. Here's a critical chart that shows that renters will see renewal rent increases cool quickly and significantly in 2023. So if the average nobody, like myself, can understand CPI data, how it's calculated, and how the numbers are artificially reading high, how come the Fed can't do that? It blows my mind every time when we get data that's been misconstrued because of the way they calculate it. Just take the BLS data from January where it showed 517,000 jobs. And once we dug into that, we saw that the numbers were artificially high because the weighting of how they calculated those numbers had changed. But yet the Fed didn't take that into account whatsoever. And they're doing the same thing with shelter data. They have to know that that data is being misrepresented at the moment and that it's likely to come down, which should help inflation numbers improve. In fact, I'm surprised that they're surprised that the numbers weren't any better in January, as this is something I talked about in a video back in mid-January when we talked about the numbers that were likely to come out on CPI with regards to expectations. In fact, here's the chart that we talked about in that video where we talked about January CPI being released on February 14th, and we said that there's a high replacement on overall core, a low replacement on shelter, and that it may be hard to see any meaningful progress. And that's exactly what happened in the CPI report. Yes, we saw some progress, but it wasn't meaningful. It wasn't to the number that they wanted to see. And because of that, the market reacted with volatility because the Fed remained super hawkish and started flexing again with the idea of continuing to raise rates at a time when many traders out there thought that March might be the last hike. So let's take a look at how the CPI print changed the probability on future rate hikes. So March has more or less remained the same. They're expecting a 25 basis point hike, taking us up to 5.75 to 5%, and that's more or less what was expected. They're now expecting another rate hike of 0.25% on May 3rd, taking us up to 5 to 5.25%. And this wasn't expected prior to the latest CPI data. On top of that, June 14th, they're expecting another 0.25% rate hike, taking us up to 5.25 to 5.5%. Again, this was not expected at all, and at the moment just remains a 50% chance. But nevertheless, there's 50% of traders out there actually anticipating another 0.25% basis hike in June. And in earlier videos, we've talked about the idea of the Fed cutting this year. I don't actually think that's likely to happen, but interest rate traders out there believe that there's a chance that it actually happens in December of this year. It was November prior to that Fed meeting, but now it's been moved to December. So while I personally believe that inflation data is likely to continue cooling, at the end of the day, it doesn't really matter what I think. It matters what the Fed thinks. And I believe that if the Fed continues to hike the Fed funds rate, it's going to raise the possibility that we're going to have a hard landing versus the potential of a soft landing. And the reason I think this is going to happen is because the Fed remains aggressive versus just taking a stance back and waiting to see what happens with the economy. Fed rate hikes don't impact the economy immediately. It takes time for these things to play out. And as they play out, it's very likely to show that what they're doing is actually working. And if they remain too aggressive for too long, they're very likely to push the economy into a deep recession, which means they're very likely to have to pull us out of that deep recession by doing quantitative easing, by pivoting, if you will. And that's what traders are pricing in towards the end of the year. They think that the Fed is going to get too aggressive and remain too aggressive for too long, which is ultimately going to hurt the economy. So while I personally believe that the housing market will remain pretty stable in the spring, there's a really good chance that the Fed remaining aggressive is going to have a bigger impact on interest rates, which in turn is going to affect buyer demand. And if interest rates remain high, I think that is super bad for housing because it's going to limit the number of people that can actually afford homes, which means that the number of sales is likely to go down. And if sellers have to sell their property, they're going to have to drop their prices to a point where buyers are interested in those homes. And over the last couple of weeks, what we saw was interest rates come down, buyer demand picked up, the housing market kind of took off again, if you will. But since then, we've seen interest rates go up. And while we haven't yet seen the effects in the housing market, we're likely to see them over the next couple of months as the data comes out. As interest rates move higher, demand is going to come down, and that's going to reflect in lower housing numbers. But with that said, you're not likely to see any crashes in housing. You're likely to see a slowdown in housing. In fact, look at this chart that shows the gains between May of 2020 and May of 2022 versus the drops in home prices since that period of time. As you can see, most major cities out there are still sitting on a ton of equity. Even though those markets have seen a decline in prices from the peak, the majority of those homeowners have a lot of equity and are sitting on super low interest rates. Now, I know everybody out there is going to say, well, what about the people that bought in the latter half of 2022? Anybody buying now, they're going to be underwater. Well, there's some truth to that, right? If you bought a house in 2022, there's a chance that you're underwater on that home. And there's a chance if you buy a house now, there's the potential that you could be underwater on that home at some point in the future. But with that said, there's something very important to note. None of that matters unless you have to sell that home. So as long as you're buying for the right reasons, you have a longer term time horizon, you have money in the bank, then you're likely in a very good spot. Now, if you're still planning on buying a house and wondering how the Fed's reset of interest rates might affect you as a buyer, do me a favor and check out this video here.